And imagine this. You're a pension fund manager in California. Your portfolio holds $68 billion in Chinese and Hong Kong equities. It's 2026. You grab your morning coffee, check Bloomberg, and your stomach drops. The Shanghai Composite has plunged 25% in a single month. Not a normal dip, a full-blown collapse. Retirees are calling. Your board is demanding answers. And just as panic sets in, Beijing announces it's selling U.S. treasuries to fund domestic stimulus. Your crime? Thinking diversification meant safety. The result? Your fund's exposure to emerging markets just wiped out 3 years of gains overnight. By the time the quarterly reports hit and the political fallout began, it hits you. China, yes, debt crisis. Isn't T just Beijing? Yes, problem. It is your problem too. This isn't fiction. This is the roadmap being written right now by the International Institute of Finance, the World Bank, and Goldman Sachs Research. And it's the blueprint for why your mortgage rate, your retirement account, and your cost of living in 2027 depends on what happens in Beijing this year. Here's the thing that keeps institutional investors up at night. We're watching the world's second largest economy carry $10 trillion in hidden debt, while most people think it's just another emerging market story. On one side, Chinese officials are refinancing local government obligations to prevent a municipal collapse. On the other, they're building a debt time bomb that makes the 2008 financial crisis look like a dry run. Same warning signs, different geography, and the outcome over the next 24 months determines whether global interest rates stay manageable or spike into economic chaos. 3 interlocking crises. 3 completely different transmission channels. 3 reasons why you can't ignore this, even if you've never invested $1 in China. The hidden debt crisis estimated at $10 trillion. The banking system fragility with systematically understated bad loans. The currency devaluation pressure that exports deflation to your doorstep. By the end of this, you'll understand exactly why China's total debt hit 301% of GDP, why 500 rural banks are being absorbed to prevent collapse, and why the phrase Japanification terrifies every central banker on the planet. Let me show you the 3 fault lines before they trigger the earthquake. Number 1, the admission that's hiding in plain sight. The global financial system is carrying $318 trillion in total liabilities. That's not a typo. $318 trillion. And here's the part that should terrify you. While advanced economies have been deleveraging since COVID, China has been doing the exact opposite. Private debt surged by more than 17 percentage points of GDP between 2021 and 2024, reaching 206% of GDP. Public debt climbed to 88% of GDP in the same period. Combined, China's non-financial sector debt hit 301% of GDP and is projected to reach 339% by 2029. Let that sink in. While America, Europe, and Japan were pulling back on leverage, China was building a debt supercycle that now represents the single largest concentration of financial risk in the global system. This isn't emerging market typical. This is a debt load that matches or exceeds advanced economies, but with none of the institutional buffers that make Western debt manageable. Here's the brutal math. The International Institute of Finance warned that emerging market debt to GDP hit a record 245%, which is 25 percentage points higher than pre-pandemic levels. And here's the kicker. That surge is driven almost exclusively by China and the United States. Strip China out, and emerging markets are actually deleveraging. Put it back in, and you're looking at the fastest peacetime accumulation of debt in modern history. However, number 2, the local government time bomb. You're not supposed to notice. Local government financing vehicles. If you haven't heard of them, that's intentional. These are the shadow entities that Chinese local governments created to bypass federal borrowing restrictions. The mechanism is elegant and catastrophic. Local governments would set up these vehicles, borrow from banks and bond markets using land use rights as collateral, and fund massive infrastructure projects. For 2 decades, this worked because property values only went up. Then came 2020. China introduced the 3 red lines policy, a regulatory framework designed to constrain developer leverage. It triggered a liquidity crisis in the property sector. Land auction revenues collapsed, and suddenly, local governments that had been funding their operations by selling land had no revenue stream to service their debt. By 2022, local government revenues from land concessions totaled approximately $1.2 trillion. As land sales plummeted, interest payments on LGFV debt became unsustainable. The hidden debt, the obligations that don't show up on official balance sheets, is estimated at anywhere from $1.5 trillion to $8.8 trillion. That upper estimate represents nearly 47.6% of China's entire national output. In late 2024, Beijing announced its response, a $10 trillion RMB debt swap program. The official story: provide immediate relief by converting high-interest, short-term implicit debt into lower-interest, long-term explicit debt. Fitch Ratings projects this could save local governments $150 billion in interest payments through 2028. Here's what they're not telling you. This is a refinancing exercise, not a stimulus. Research from Shenwan Hongyuan Securities shows that using bond quotas for debt repayment rather than new projects has dragged down national investment growth by more than 3 percentage points in early 2025. China isn't investing its way out of this crisis. It's buying time. And time is the one commodity debt supercycles don't grant. Number 3, the banking fragility that could break the global system. China's banking system holds $67 trillion in assets. That's not a financial system. That's a systemic risk amplifier. The official non-performing loan ratio for commercial banks is reported at 1.49% as of mid-2025. Stable, controlled, manageable. Here's the part that keeps risk analysts awake. Research suggests Chinese banks have been systematically understating bad loans by a factor of 2 to 3. Total bad debt is estimated at around $730 billion. These loans don't just disappear, they're moved off balance sheet through asset management companies, or masked as special mention loans, which totaled $730 billion in Q2 2025. The risk is particularly acute for rural and regional banks. Approximately 500 of these institutions are currently being absorbed or reorganized. These banks have a hypothetical standalone credit profile as low as B or B, meaning they're surviving on implicit government backing, not financial health. They're heavily exposed to LGFVs, the same local government entities sitting on trillions in hidden debt. Here's the nightmare scenario. If even 5% of LGFV debt defaults, it would result in a 75% increase in the banking system's total non-performing loan volume. That's not a manageable adjustment. That's a localized banking crisis that could ripple through the entire $67 trillion system. And here's what makes this a global problem, not a Chinese problem. When banks face a solvency crisis, they stop lending. Credit freezes, businesses can't finance operations, trade transactions dry up. And China is the world's largest trading nation. A Chinese credit crunch becomes a global supply chain seizure in a matter of weeks. The historical parallel that terrifies every central banker. There's a phrase you hear in every sovereign risk briefing, Japanification. It refers to Japan's experience in the 1990s, when an asset bubble burst and the economy entered 3 decades of stagnation. The parallels between Japan in 1990 and China in 2025 are striking. Both experienced explosive growth fueled by high domestic savings. Both relied heavily on bank financing rather than capital markets. Both built massive speculative bubbles in real estate. Both faced a sudden reversal when asset prices crashed. But here's the critical difference. Japan's population continued growing for nearly 2 decades after the bubble burst. China's population started declining in 2022. Japan was an advanced economy with per capita income over $40,000 when its crisis hit. China is entering its debt crisis with less demographic cushion, lower per capita wealth, and a more hostile external environment than Japan had. And Japan's stagnation lasted 30 years. China doesn't have 30 years. The currency crisis that exports deflation to your doorstep. While the U.S. Federal Reserve maintained high interest rates through 2024 to combat inflation, the People's Bank of China cut rates to support the flagging domestic economy. The 1-year loan prime rate dropped to 3.15%. The required reserve ratio was cut multiple times. This created a massive interest rate differential between the U.S. and China, putting downward pressure on the Chinese yuan. In early 2025, Beijing reportedly reverted to an implicit peg of the RMB against the USD, holding the rate between 7.17 and 7.18. This was designed to prevent disorderly capital flight. But market pressure remained evident in the Hong Kong offshore market, where the RMB traded significantly weaker. A significant devaluation of the RMB has 3 immediate global consequences. First, it exports deflation. China's producer price index has been in contraction for nearly 3 years. A weaker currency allows Chinese manufacturers to dump products on global markets at even lower prices. This floods Western markets with cheap goods, undercutting domestic manufacturers and reinforcing deflationary pressure just as Western central banks are trying to stabilize inflation. Second, it hammers commodity prices. China is the world's largest importer of raw materials. A weaker RMB reduces China's purchasing power, leading to a slump in global commodity prices. This devastates the economies of major exporters like Australia, Brazil, and African nations, whose fiscal stability depends on resource revenue. Third, it triggers capital flight risk. A sharp devaluation could spook both domestic and foreign investors, accelerating capital outflows. This destabilizes the financial systems of emerging markets that have close trade ties with China, creating a cascade effect across the developing world. What history teaches us about asset performance. During debt collapses, the 2015 Chinese stock market crash provides a template. Between June and July 2015, the Shanghai Composite fell 25%. The tech-heavy Shenzhen Exchange plunged 35%, wiping out $3.5 trillion in market capitalization. That's an amount equal to China's entire market cap in 2012, evaporated in weeks. At the time, global markets remained relatively insulated because foreign investors owned only 1.5% of Chinese shares. In 2025, the level of integration is vastly higher. Western pension funds, endowments, and sovereign wealth funds hold tens of billions in Chinese and Hong Kong equities. The Evergrande default in 2021 was another warning shot. Evergrande's liabilities alone were equivalent to 2% of China's GDP. The crisis caused the S&P 500 to experience its worst day in months, down 2.224%. The VIX volatility index spiked to 26.7. This was a single developer. Now imagine a systemic banking crisis affecting a $67 trillion financial system. Since 2020, gold has been the best performing major asset class globally, delivering an 18.4% annualized return. It's reached all-time highs twice as investors sought shelter from inflation, geopolitical risks, and the perceived fragility of sovereign debt in both China and the United States. The Treasury market. Time-bomb China is currently the second largest foreign holder of U.S. debt, with approximately $759 billion in Treasury securities as of late 2024. This is not just a data point. It's a systemic vulnerability. As China's domestic fiscal space tightens, there's an increasing likelihood Beijing will reduce its holdings of U.S. assets to fund domestic stimulus or defend the RMB against depreciation. Even small percentage shifts in these holdings can move hundreds of billions of dollars. Foreign demand represents about 30% of publicly held U.S. debt. If that demand weakens, the U.S. government must offer higher interest rates to attract buyers. Because Treasury yields anchor mortgage rates and corporate borrowing costs worldwide, a Chinese sell America trade leads to a global tightening of financial conditions. This creates a paradox. A Chinese economic slowdown doesn't just hurt China. It increases the cost of borrowing for a homeowner in Ohio, a small business in Germany, or government in Brazil. The transmission mechanism runs through the Treasury market, but the consequences are everywhere. The pension fund dilemma congressional investigations in 2024 revealed that roughly $6.5 billion from American retirement accounts had flowed into 63 blacklisted Chinese companies. By 2023, 72 of the largest U.S. public pension funds held a combined $68 billion in Chinese and Hong Kong assets. Political pressure is mounting. More than a dozen states have urged their pension funds to divest from China due to rising geopolitical risk, particularly over Taiwan. But divesting creates its own problems. Shifting from the standard MSCI Emerging Markets Index to an EM ex-China index significantly alters the risk-return profile. The ex-China index historically shows higher volatility and a 0.75 correlation to the S&P 500, compared to 0.68 for the broad index. China represents a large portion of global equity indices. Eliminating it reduces exposure to the world's second-largest economy, particularly in consumer discretionary sectors, which dropped from a 14.6% weight to just 6.5% in an ex-China strategy. Fund managers face a brutal choice: maintain exposure to a debt crisis or divest and potentially underperform benchmarks. The interconnected vulnerabilities of 2026. Economists are watching for the first domino to fall. The 2026 Global Risks Report identified geoeconomic confrontation as the top risk most likely to trigger a material global crisis. Several interconnected vulnerabilities are converging. If Japan's bond market experiences a pricing crisis due to its own debt sustainability concerns, the resulting global rate spike would break China's fragile restructuring effort. If the overheated AI sector collapses and triggers a global credit contraction, it would hit Chinese tech exports just as domestic demand remains anemic. If mounting trade wars escalate into full economic decoupling, the global trading system fractures along geopolitical lines. Goldman Sachs projects China's GDP growth at 4.4% to 4.8% for 2026. The World Bank and JP Morgan forecast global GDP growth at 3.2% to 3.3%. China's Producer Price Index is expected to turn positive by early 2027. The U.S. terminal interest rate is projected at 3.0% to 3.25% by Morgan Stanley. These are consensus forecasts. But consensus forecasts don't account for tail risks, and China's $10 trillion debt crisis is the definition of a tail risk with systemic consequences. Why this is your problem. China's debt crisis is not a singular event contained by geography or politics. It's a systemic feature of the modern global economy. The $10 trillion debt swap program is a necessary but defensive maneuver to prevent a collapse of local government services and a banking crisis. For the rest of the world, this manifests through volatile treasury yields, shifting pension fund returns, and the export of deflationary goods that challenge the survival of Western manufacturing. The lesson from Japan's 1990s crisis and the 2008 global financial crisis is clear. Debt supercycles do not end quickly or cleanly. China's transition from an investment-led model to a consumption-led model is stalled by a massive property overhang and a shrinking population. As long as China remains the world's manufacturer and a primary holder of global reserves, its debt reckoning will drive global financial risk. The fault line isn't just in Beijing. It runs through every major financial center in the world, influencing mortgage rates in Phoenix, pension security in Frankfurt, and commodity revenues in Sydney. If you're realizing that the next 24 months will determine whether we face a managed slowdown or a systemic crisis, hit that subscribe button. This is the Independent Financial Historian. I show you the structural risks before they cascade and the autopsy reports after markets collapse. It's free, unlike financial stability in a world built on $318 trillion in total liabilities. Drop a dragon emoji in the comments if you're repositioning portfolios ahead of the China risk. And tell me what structural vulnerability you want me to investigate next. I read every single one. The only question is whether you'll see the contagion channels before they activate, or whether you will be standing there in 2027 wondering why your pension lost 30% of its value when a banking crisis in rural China triggered a global flight to safety. The $10 trillion restructuring is happening right now in Beijing, being monitored in Basel, priced into markets in New York, and affecting your financial future whether you're paying attention or not. Now go stress test your portfolio before the first domino falls.